module overview. Module 9 of the course. Creating a business budget focuses on one of the most strategic and forward-thinking aspects of financial planning, budgeting for business growth and expansion. While earlier modules addressed the mechanics of setting, tracking, and adjusting budgets for existing operations, this module explores how businesses plan and allocate financial resources for scaling, innovation, and long-term development. Growth budgeting is not just about increasing revenue or expanding operations. It's about strategically investing in opportunities that yield sustainable and profitable returns. This module provides a deep dive into evaluating growth readiness, setting expansion budgets, assessing financing options, managing risk, and ensuring growth aligns with business goals. Understanding growth and expansion. 1.1 What is business growth? Business growth refers to any measurable increase in revenue market share, customer base, workforce size, product or service offerings, operational footprint, new locations, new countries, etc. 1.2 Types of growth. Organic growth, achieved internally through increased sales, improved efficiency, or new product development. Inorganic growth, achieved via mergers, acquisitions, or partnerships. Vertical growth, adding new stages to the supply chain, e.g., manufacturing your own inputs. Horizontal growth, expanding into new markets or offering similar products in new regions. Strategic planning for growth. Before budgeting for growth, businesses must assess internal capabilities, HR, operations systems, market potential, demand, competition saturation, financial readiness, cash flow, reserves, borrowing power, strategic alignment with mission and vision. 2.1 Setting growth objectives, increase annual revenue by 25%, launch 3 new products within 12 months, enter 2 new regional markets, hire 20 new staff for operational scaling, invest in new infrastructure, tools, or technology. 2.2 Growth budget as a roadmap. Growth budgeting translates strategic objectives into concrete, fundable actions. It's used to prioritize investment areas, allocate funding across departments, forecast capital requirements, anticipate risks, and mitigation strategies. Components of a growth budget. Budgeting for growth involves forecasting and planning in specific strategic areas. 3.1 Capital expenditures, CapEx, property acquisition or lease, machinery, tools or equipment, renovation, expansion or build out, technology upgrades or automation tools. 3.2 Human capital investments, recruiting and onboarding, training and development, employee retention initiatives, leadership hires for scale. 3.3 Marketing and sales expansion, advertising and promotion campaigns, digital marketing and SEO, trade shows, product launches, new customer acquisition strategies. 3.4 Product development, research and development, R&D, prototyping, testing, iterations, packaging and compliance. 3.5 Infrastructure and systems, IT infrastructure, ERP or CRM systems, cybersecurity and data protection. Financing business growth. Business growth requires capital. Funding options include 4.1 Internal funding, retained earnings, diverting budget surplus, cost savings from operational efficiencies. 4.2 Debt financing, bank loans, microfinance and development finance institutions, DFIs, government grants and intervention funds, asset-based lending. 4.3 Equity financing, angel investors, venture capital, crowdfunding platforms, strategic partners or joint ventures. 4.4 Hybrid approaches, combining equity and debt, revenue-based financing, mezzanine financing, risk management in growth budgeting. Growth always carries financial and operational risks. These should be proactively assessed and embedded into the budgeting process. Common risks. Overestimating demand, underestimating cost, market entry failures, delays in production or delivery, talent gaps, risk mitigation strategies, create buffer budgets, use phased investments, pilot, test, scale, secure legal and regulatory compliance, maintain emergency cash reserves, conduct regular scenario analysis and forecasting, monitoring and scaling responsibly. Growth budgeting doesn't stop once funding is allocated. Ongoing monitoring and review ensure growth is sustainable, efficient, and in alignment with strategic goals. 6.1 Growth KPIs to monitor return on investment. ROI, customer acquisition cost, CAC, lifetime value of a customer, LTV, employee productivity rates, time to break even. 6.2 Expansion milestones. Break down the growth roadmap into measurable phases with budget triggers. Phase 1, market research and pilot, $50,000. Phase 2, product launch and marketing, $120,000. Phase 3, hiring and infrastructure, $200,000. Each phase should only proceed if milestones are met. Ethical and strategic alignment. Not all growth is good growth. Ethical budgeting for expansion must align with the company's values, support fair labor practices, respect environmental sustainability, deliver value to customers and communities. Strategic expansion ensures the business doesn't grow beyond its capacity, compromising quality or reputation.